Good morning. It is Wednesday, September 24th. I am Zack Howard. Here's my morning market update. Today, a little bit later, getting this update out there. But I want to talk about today commodities as it relates to the macro backdrop. I want to talk about the risk on of US equity and overall global markets. And could this be the biggest bubble of all time? Well, no doubt about that at this point. But at this point, we still continue to be risk on and play the bubble. And we'll look at signs where that bubble is going to potentially collapse. Looking at history, let's start off with copper. Copper and natural gas now potentially going back to bullish trend. One of the only commodities that hasn't been bullish. Oil popping the bullish trend as well. We had the tariffs on copper, ran right up here to an all-time high. Trump tanked it within 24 hours. Inside information, boom. And here we are back to a nice solid. This is a nice looking chart. Just looking at this chart without knowing what the commodity was, but potentially breaking out above $5 US a pound today. What's the fundamental catalyst in that besides continued global growth? Copper's often referred to as Dr. Copper as a barometer if global growth is increasing or decreasing. But there was a massive mine incident here at the beginning of September, just coming on to the fundamental side here today in Indonesia. Freeport-McMoRan, the biggest iron ore copper producer out there globally, represent about 8% of copper production worldwide. And they had this major incident here, which is often the case in wet conditions and mining activities, particularly in these undeveloped areas like Indonesia. But this is a massive mine that's now offline for the rest of 2025, potentially into the latter part of 2026. 3% of global copper supply, also a big source of gold for the company as a byproduct of that mine. So this is going to have implications, not just shorter term or long term. Copper is going to be essential through the build out for the AI, through the digital space, electricity infrastructure. Without it, it just isn't going to happen. This is another tailwind for that. On the backdrop of that, global macro in the US yesterday, above 50 is good, below 50 is contracting. A little bit of rate of change slowdown from the previous month in all three categories, but still relatively strong here. Looking at the service, manufacturing, and global composite PMIs. So that's another backdrop for bullish commodities, bullish copper, particularly with those fundamental supply deficits potentially coming here on that mine closure. Let's look at this tier 1 alpha. They do great work out there on a day-to-day basis inside the lens of the machine. That is flows, that is volatility. If you're really serious about day-to-day market moves, tier 1 is a place to go for your daily market info. Green dots, risk on, red dots, risk off. Despite the run up, we are still in risk on in this volatility compressed regime. According to their data, scream all you want about valuation. Doesn't matter. The machine doesn't care. Further to that, no sign of stress out there in the most de-stress potentially of credit side of the market, which would be in the junk high yield space. We are at record low spreads. The upside potential for owning high yield credit here in this environment, I don't really see it. Is it a time to short? Don't see that either. But to me, no indications of any stress at all. This is despite in US bankruptcies actually ticking up rate of change, but not showing up in wire spreads in that credit side of the market yet. Historical low implied volatility on the HYG ETF. I have forgot about as a way to potentially hedge a downturn in markets is the SJB inverse ETF for that high yield space. You get a positive 5% carry by putting that on. I just put like small 50 to 75 basis points to remind me in my portfolio yesterday. Put that on there and pay attention to this. If we are going to get stressed down the road in 2026, that is probably a more attractive way to play the market as a hedge as opposed to shorting equity straight out. Nice risk reward for owning that here with a longer term outlook. Like I say, this just, it's unsustainable, but for now it kind of lines up with the rest of the volatility that's been compressed. Look at the move index, which is the treasury volatility. in the US down to 75, 80 in that range, completely compressed, just like US equity. Volatility continues to be compressed in this 14 to 17 range for the VIX. But when I see headlines like this come across, we are in the late stages. The fiat game is just pushing the limits here wherever we can go. 300% leverage at the blackjack table. I sit down and I have $1,000 in chips, and the house wants to credit me with 300,000 to play with. Yikes! There's lots of potential to do big upside here, but also potential to have massive liquidation events like we've seen on Sunday night in the crypto space. And the mooch, he's back again, and he's floating another shitcoin, the Avalanche plan. When they start rolling the mooch out and Kevin O'Leary and dudes like that, to just pitch your shitcoins, it's getting late in the cycle. Not a time to be really digging in your heels here to be taking a high beta risk. Yes, me, but then move over Vietnam when it comes to raising capital of your government. You are just a small fry out there. These technology companies are just massive that are on unwavering ability to continue to raise capital and just throw it at the wall. And it's AI projects. NVIDIA arguably back and forth here. They were supporting their customer by putting another 100 billion into OpenAI to build out its infrastructure. Back to the copper theme, 10 gigawatts of AI data centers. That's going to require a whole lot more copper. Even if it comes in at half this, the build out is going to be continuous, and the supply of those hard commodities is real. Tether potentially raising 20 billion at a $500 billion valuation, private company. Crazy. Some of these valuations in the tech space is just unbelievable. Nothing rivals it in oil and gas, traditional finance. It's out of this world. But 25 years later, these are the darlings of the stock market and global equities today. Those Mag 7, Mag 10 stocks, put Oracle in there now too, if you like. 25 years ago, during the dot-com crash, are these companies still relevant? To a certain extent. Yeah, they're still around, but they don't play the same role in market cap weighings in the S&P as they do today. Are we at peak bubble here? 40% of the S&P through these 10 companies? I don't know, but so far, so good. But when it does implode, it could be nasty, which just means more money printing in the end, more devaluation, that fiat currency. Looking back in history, right from the 1700s, right up through the 1900s, reminds me of my favorite scene at a margin call dinner scene movie, where the managing partner runs off all these times. Is it different this time? I don't think so. I just more of a bigger Jenga board, more of a tower in the sky until it tips over. But that could be another year, 2 years time, for sure. But we are up there. We're definitely in eye-watering territory. Let's look back in the hard assets, hard money themed in this college. That's in the Costco. And the girl at the cash told me they're selling these 10-ounce silver coins like crazy. I couldn't believe it. Limit of 5 per 4 days. And in the gold ounces, we're at 5,300 Canadian per 1 ounce of gold coin. Silver 66 an ounce in terms of what that's offering here. That's what I got for you today. Have a great day. We'll see you soon.